Now we get to kick off with OPEC and their most recent report for November. So here you can see on the secondary sources that they've decreased production by about 210,000 barrels a day. And you can see who drove that, which is obviously Saudi Arabia. Nigeria, small bump. Libya, again, as we've been saying continuously, very stable at this point, and stable is obviously a relative term. But Iraq is a key one that we wanted to highlight because we don't see them going along with their normal cuts. We think they'll be above. And then UAE, something very similar. Now, it's always going to be important to look at what are exports versus what is happening on the production side. And one of the key pieces when you look at production, we just think that Saudi Arabia is going to cut. That was never a question in our minds in terms of them cutting. Just because when you look at floating storage, there's a lot of floating storage out there, especially in the Middle East. So there's going to have to be some of that adjustment to say, okay, well, how do you clear some of this glut? And the view was that China was going to purchase some. We've continued to see them buying significantly on the from Russia, and that's again put more product back into the Middle East and also West Africa. And then as CPC has come online, that again is, or I should say more flow from CPC and more and exports remaining elevated from the US, that has displaced some of that West African crude, which is again keeping some of those pressure in terms of differentials and spreads when you look at what is happening in the West African front. Due to a weaker economic backdrop and China's strict anti-COVID measures, OPEC lowered estimates for the amount of crude it will need to pump this quarter by 520,000 barrels a day, following a similar size downgrade a month ago. And as we've been saying, it's that they were too high on demand, and demand's coming down. But again, 520,000 barrels out of a 99 million barrel a day number is, again, there's a lot of fungibility in this, and that's same with supply in terms of some of the different flows. But as demand has come down, so has supply in different ways. So in terms of flows, like lost volumes coming from Russia, some of the flows coming from OPEC. So again, there's still some of this balancing act in general, and that is where we continue to see some of these different product shifts in general. And that's when we start looking at, okay, well, what's going to happen going forward? So the United States is happy, has said that it's happy for India to continue buying as much Russian oil as it wants, including at prices above a price cap from the G7, and that's coming from Yellen, because essentially we're saying India can do what it wants, and if they buy cheaper crude, it's actually good for us because we import from India, we import from Asia. So, excuse me. If their prices come down, then we import the lower price. So again, the PPI thing, the PPI side continues to be a benefit for us if we bring down their costs. And as we've been saying from the beginning, we're going to let them do what they need to do. We're going to diminish the amount of crude significantly coming into the European markets, the US markets, but by putting a cap, you also normalize, or you legitimize some of the Russian crude. So by legitimizing some of that Russian crude, you allow them to also increase some of their exports where they've been hindered before. And then there's a workaround to, again, paying some above that cap, which is what we expect to see more of and more from in the Middle East and in Eastern Europe. And not to pick on one specific bank, but there is a bank that has been fined billions of dollars for skirting sanctions with Iran, which is something that they're likely to be the target this time of doing that. The other key pieces in Iran, we've actually had employees walk out of the oil producing areas. And that is a big thing, because in 1979, the revolution was, people died. Thousands of people died. I'm not saying they didn't, but it was fairly bloodless if you consider about a revolution. Because if I were to tell you there was a revolution in this country, you would immediately think a lot of bloodshed. So in 1979, during the Iranian Revolution, the key linchpin were people walking off site and again supporting the cause that brought in the current regime or the current view of the of how to run the country. And now we're getting the exact same thing, but for the opposite side, where the energy producing entities, the oil guys, the refining guys, and petchem guys are walking off site, which just shows you how much momentum sits behind the current protests and the current issues. And this is the whole thing that we've talked about. The protests have been happening for years, especially against when something like this happens against women. This is the first time in this time frame that we've seen it get to this level, which is why there is legs to this, and it's going to be something to watch as we head into 2023. Short term, it's going to take product out of the market. Long term, it could actually bring product into the market, because if we get a much bigger change in the regime, that would again attract additional investment, whether that be from Europe or the US would take way more time, but just give you an idea of some of those shifts. On the demand front, you can see here that fourth quarter of 22 has come down. We think it's going to continue to come down as we see some of the different shifts. Saudi Arabia is reducing oil shipments. Group shipments are down significantly but for the first 15 days of November. There's still time to pick that up. And again, that's going to be an important one to watch. Exports are likely to see some improvement in the second half, bringing overall drop to about 1 million barrels a day in November. But that's okay when you consider the amount of floating storage. And some of this may be just because they're putting it on land storage and they want to be able to clear the glut, because let's be fair, shipping is expensive. So let's let some of that clear so they can get some of that back into the market. World oil demand going forward into 2023, you can see that there were some reductions across the board. We expect reductions to continue just because of the economic pressure, which is going to bring us much further down. And again, much further, just, do I think fourth quarter of next year is going to be 103 million? No. But it's also important to understand that 103 million includes liquids. So if you want to say that, okay, well, propane and LPG demand is going up, petrochemical demand is going to start to recover by fourth quarter, that number is doable. So I think it's important to remember that 103 includes black oil as well as NGLs and liquids, and we still remain very supportive of liquid demand on the longer term when we look into the back half of next year. China's dependence on Russian oil continues to move higher. And again, they're just taking advantage of these discounts. And that's, again, leaving more of that crude in the Middle East. And it's not that they're not taking term, because they're taking term contracts. They're taking what they've agreed to. It's just they're not taking extra. And that's leaving some of that excess in there. And then Europe is like, well, you're expensive, they went to West Africa. West Africa got expensive. CPC has come back. U.S. is still at a discount, so they're increasing some of the Mediterranean suite, some of the stuff coming from the U.S. and diminishing what they're taking from the Middle East and from West Africa, which is why, as Asia, which was the swing, is taking more from Russia, that's leaving those crudes in those markets. The race against time, as you see additional big shifts in oil product exports. A lot of that unidentified is again heading into the Middle East. We expect that to remain the case in order for them to maintain their current flows. Now, when you look at floating storage in the Middle East, this is what we're talking about. We're bouncing back up, and that's against seasonal norms. You can see that we typically are trending down at this point in time, and instead we have this excess, and the excess is why we're getting some of that reduction in exports, because they're trying to sell and clear what is sitting in the water. And that's going to be an important one to watch, and why we do expect to see additional softness in OSPs. Unless they can clear this faster, we should see OSPs come down again to incentivize some of these moves. Now, U.S. exports continue to remain, according to this, over 4 million. We still have us at about that 3.8. That's something that is going to continue. Again, back to the spreads that we see. Currently, Brent is at 92.50. LLS 88.90, still a lot of wiggle room to move that product into the market. Now, when we look at Dubai swaps, you can see that there's Brent has started to come down a bit in terms of this, and that's why we expect to see some of that additional discount coming into the Middle East. Now, Saudi Arabia doesn't give discounts; they give incentives, which again you can calculate what that incentive comes to. But when you look at Dubai and some of the different flows in general, that's where we could see some of the discounts come through. Iraq can give some of them as well. And that's where we continue to see it stay at about $8. There's not too much movement up or down. It may be a little bit to the upside at $8.50, but those spreads are going to be important, especially when you start looking at the discounts that are starting to get pushed through again in West Africa. Crude oil on the water still remains elevated, coming down, but the movement down is more driven based on floating storage because oil in transit still remaining very elevated, staying at the highs. A lot of that is flowing into Asia, but that timing delay is what we've talked about. A lot of that crude is in transit. It is not in floating storage. It is not on land storage. So there is more behind it, which is going to replace some of what is in floating storage and again, push more into what is currently in the market, which is why when you look at the floating storage dropping below that 2016 level, we expect it to just go sideways, but not in a straight line, which is why we've been saying that the comps get easier as we get into year end. And as some of this crude in transit shows up, you'll see an increase in floating storage. And you've already seen that in some key areas, while Asia has seen that big drop, but they've been slow steaming a lot of their cargoes. So that's where we expect to see the biggest increase in storage as we go through the remainder of this year. And again, not to say that we're going to get this big surge, but just stay at a fairly elevated level as we get some of that oil showing up in transit and converting into that floating storage. And here's some of that support where the super tanker tracker is showing just the amount of cargoes that are designated to head to China, which means that they will also come to these different pieces. And that's where I think we're going to see where some of the problems are and how this is going and where that's going to remain. And again, as these cargoes show up, you're going to see that floating storage also increase as well. So now when we look at China, on the teapot side, teapot activity still remains fairly depressed. That's going to stay the same. The focus is driving some of the state-owned guys. So China maintained its oil processing near the highest level since February. Nation refined 13.86 million barrels of crude in October, marginally lower than September, which was the highest in the level in 7 months. So they're trying to, again, process that crude. They've started to increase exports of product, freeing up some of that space. But there's a lot of things that have to be moved because the volume process was the most since December of this last year. But there's a lot of quotas to make up, and that's why you're going to see that ramp up. And then the question is, are we going to see a meaningful opening up, if you will, of the Chinese economy? And my short answer is going to be muted. It'll be a muted opening, and we continue to see the hindrance on just the underlying economic data, because even when China wasn't in lockdown, the economic data was terrible. So we don't expect to see, the country's opening up, therefore things are going to surge. No, there is an economic problem. There is a macroeconomic issue in China that is not going to get fixed if you can go about, because people are not spending, people are not looking to, jobs are fading. The concern is rising on the future. Values are coming down. Most people in China are very levered to housing and real estate, and all of those things have gotten knocked around. So they're not as wealthy as before, and again, that's going to result in less spending. West African crude continuing to rise, which is why we see those differential discounts increasing. just because they're trying to, again, compete against what's happening in the Middle East and trying to incentivize that. So we do see more discounts coming into West Africa. Crude products, finished gasoline, the exports dropped 65,000 barrels a day, still elevated. Distillate had a big drop of 263,000 barrels a day, still fairly close to the 5-year average. Propane, propylene, again, as we've been saying, it's gonna stay strong, even though local demand is diminishing, petrochemical demand is diminishing abroad. There's still LPG is very flexible, and the U.S. is producing the most because if Saudi Arabia produces less oil, they inherently produce less LPG, which again, they then turn to us to supplement. Total crude exports bounced to 3.86 million, again, right in line with where we are and where we think the average is. Gasoline exports are going to stay strong just because of the spread between where storage is. PADD 3 storage is still very normal. A lot of opportunity to try to get that into the market. But again, distillate is going to remain the focal point, which is why when you look at distillate, it fell back right at the 5-year average. We expect this to remain a bit on the elevated side just because of the demand centers within the Atlantic Basin. Ethane exports came down. They'll just bounce back up. Again, it's just because of the timing delays. Excuse me, that's something that's going to remain on the higher side. Crude oil exports, again, staying very strong. And just based on pricing, we don't see that changing. LPG remaining at the highs. Again, don't see that changing in general. Fujairah, November total oil product stocks were at 23.858 million, a draw of 1.3 million barrels. And again, that's back below the 25 million. Middle distillates posted the greatest overall draw of 678,000. So light distillates fell 441,000. The East of Suez gasoline complex was finding some support with fresh buying interest from India. So again, there's a certain amount of the timing delay. India's demand for gasoline imports is expected to remain stronger on the back of increased driving activity for year-end festivities, elections, and tight available domestic availability. So again, festivals, elections are going to keep things fairly elevated. But when you look at light distillate and you look at Singapore, you look at some of the flows, we still see a lot of issues when you're looking at light distillate storage because it's still elevated. So gasoline is still going to have some margin issues. But that's why when you consider the import into Fujairah, which is representing the Middle East, you're going to import more of that Russian crude, Russian product. That'll supplement some of your storage. You'll try to export what you can. But then when you look at Asia in general, as we come to the end of festivals, as we come to the end of elections, and we get into January, that's where we see the most risk for gasoline increases in storage, which is going to decrease crack spreads, and we're going to have to rely on that middle distillate crack more and more. And if there's any softness in there, that could lead to those economic run cuts in January and February. Middle distillates, including diesel and jet fuel, obviously had a draw of 678,000 to 2.629 million. The East of Suez gas oil complex was under some downward pressure with easing supply tightness in the region. And then demand in the West also saw some reductions as the East to West arbitrage attractiveness that resulted in more of those East of Suez gas oil cargoes being stuck in the Asian region. So again, some of these different movements, ARB is workable. However, from Singapore to Asia is tough. So when you look at Arab Gulf, West Coast, India into the West, it's still there, but a lot of those cargoes have already started to move. So there's essentially, this is saying that there's no support right now for follow-on cargoes. So what is in motion is going to stay in motion, but there's not much reason to buy some additional. So we'll get some builds in middle distillate. That'll increase as more Russian crude cargoes come in, and then that'll open up the ARB again and move things through. Heavy resid fell 183,000 barrels to 14.419 million. They held above the 14 million barrel a day level, second consecutive week, and trading activity has been picked up a bit, but again, the shipping side still remains a headwind. Time spreads have come down. We're right at about $1.13. We still think that there's a bit of support to the higher side, but again, there's not a huge amount of demand right at this moment, which is why we've seen some of those pricing metrics come down, some of the time spreads come down, and that's why we expect to see some additional discounts come into the market. When you look at flows in general in the export market, Norway still at the high side. Nigeria's added some cargoes. Angola, you've seen an increase in January. Again, things are a bit on the higher side, but Angolan crude loadings for January set to rise to a 4-month high. Then when you look at Equinor offered some cargoes on the Platts window. Freight rates from West Africa to the UK, China at year-to-date highs. So as those freight rates go up, you have to see some of the discounts come through. So when you start looking at some of the different flows, you have an offer for minus $1.55 Brent. Unipec offered some Congo at 5.55 minus dated Brent. And then Robbie Light for early December, was expected to be at minus 45 cents dated Brent versus 20 cents, minus 20 cents. So again, some of those movements. The pace of West African crude sales for December loadings is much lower than normal, as demand from buyers of China, India, and Europe have weakened, and then the freight rates have gone up, which is what we've talked about, which is why prices have to or will come down further. About 7 out of 10 of 36 Angolan cargoes have yet to find a home. While the new loading program for January is set, most Angolan cargoes are typically cleared at this point of the month, as we've talked about. Nearly half of 46 Nigerian cargoes are still available. Demand from China is weaker than expected, partly because of the restrictions, partly because of Russia. Interest from India remains lukewarm, and we don't see that adjusting. European refiners are more interested in buying med, sweet grades, which has become more abundant, obviously because of CPC, and then high freight rates, again, deterring. While Vital sold some Fortes at dated plus 255. The grade last traded at $1.90, so we saw some of that premium come through, so it'll be interesting to see how much of that sticks. And then when you look at flows coming into Europe, some of that has come down, but again, still staying closer to the average. We see some of those timing delays, and some of that will get rebuilt with floating storage coming onshore. When you look at refined products, small draw from gas oil, small build in gasoline. When you look at gas oil inventories, still remaining at the lowest they've ever been. We don't see that changing, but again, freight rates is a problem, and we have seen some demand diminish, again, similar to the economic backdrop, which will, again, reduce some of the demand, but because of the issues on the refining side, the reduction in utilization rates because of cost, we don't see that adjusting, and that will support some of those additional imports in the near term. Gasoline above 2020 levels, again, all-time high. We don't see that changing because the ARB remains closed. It's expensive. We don't see that adjusting in the near term. Fuel oil inventories coming down a bit, but still high. Some of this will try to move into the international markets. Then when we look at Singapore had a build of about 2 million barrels. It's just right at that. When you look at total stockpiles, right at that average of the last 19 years or so. You had builds in middle distillate, that'll drop back down. Light distillate had a draw, that'll rebuild as things fade in India. Resid had a big build, but again, still holding fairly close to normal. Even with light distillates having a draw, we're still at, obviously seasonally adjusted, all-time highs going back to 2007. And then as some of that demand wanes, as we get towards the end of festival season, end of elections, this will come back up and still stay at all-time highs. Middle distillate, even with the build, still all-time lows. And just the hindrance right now is more going into China. There's still opportunity coming from India into the Atlantic Basin. Singapore still doesn't make much sense. So Singapore is going to stay in the Asian front while India fills some of that demand on the other side of the Malacca. And then Singapore is just going to continue to be a bit stuck just given some of the flows, but be supportive of crack spreads, which again will keep them fairly active just given the shortages in that market. as the resid, as we've been saying, is just going to suck around this average line, and it's just going to be a matter of who's buying what to supplement, and we don't see much changing there. Then when we look at North Sea floating storage coming down a bit, we just see it staying fairly flat, obviously lumpy, but, just fairly flat from this point in time. And then Europe, small increase. And then just as some of that comes down, again, as Europe imports more, again, it'll just go from floating storage to what's in Genscape. So fairly stable, not too much movement up or down here. So that's what we have for you in total. If you have any questions, please let us know. We'd love to hear from you on the comment section on Twitter. And we hope you have a great day. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Vision Network.